As a federal employee, your pensions are amazing. You know this, but is your strategy for retirement maximizing those pensions? In this episode, we're going to discuss retiring early and how that could affect your pensions, do an overview of CSRS and FERS, show you some bonus benefits that you get as a federal employee that most people don't get in their pensions, and finally, I'm going to reveal some secrets of why financial advisors do not like pensions. Welcome. I'm Ed Smith, President of Valor Wealth Partners, where we're dedicated to educating federal employees on how to maximize value from their complex and often underutilized benefits. In my opinion, your federal pension is the best benefit you get by far. Most Americans don't get that. But one of the things that we have to look at is there are very complex systems, and you have to understand them very, very well. Today, we're going to focus on the most impactful features for you so you can start learning about the pensions. If you want to learn a little bit more, please go to the OPM website, or we have a link in the description section of some of the workshops that we work with so that you can go to them for free and get knowledge about both your pensions and the other benefits that are available for you as a federal employee. Again, they're a full-day workshop and they're completely free for you to attend. When you look at your pension, compared to most Americans, most pensions in this country have been taken away from most corporations. But the corporations that do have them do not have COLA increases or the increases that help protect against inflation. Luckily for you, your federal pensions cover this for most years of retirement. There will be some years that you may not get this in a specific situation, but for most federal employees, you have COLA for all years of retirement. Another thing you have to look at is the value of your pension. How do you classify this? For me, I look at that every $1,000 that you receive of income from a pension is worth about $300,000 of an asset outside of a pension. The way we do this math is what's called the 4% rule. If you've never heard of this, we have created a video. There's a link in the top so you can check this out. I don't want to go too in-depth to this, but what you really want to understand is that this is a very powerful concept. For every $1,000, you would need to save $300,000. So if you had $5,000 of income, that would mean $1.5 million you would need to have in an account just to cover that. And most people do not have pensions. So this is a really good thing to be able to have. When we get beyond your pension, we want to be looking at your spending habits. And the way that we classify them are needs, wants, and wishes. Needs are the basic living expenses that you have. Your housing costs, maybe going out to dinner, and then also healthcare costs. Those are classified into the needs section. The next level is wants. And wants are the fun things that you want to be able to do. Maybe it's travel. Maybe it's something of improving the house. And then finally, it's the wishes bucket. And in the wishes section, it's things that are in your bucket list or things that you don't think you're going to be able to achieve, but you want to try to it. So you put this on the list to see if you can be able to achieve them. For people that have pensions, especially federal employees, your needs are almost always covered. Your wants are mostly covered, if not always covered, and sometimes you need a little bit of extra money to get to those wishes where your TSP or other savings may come into play. But because most Americans don't have pensions anymore, they're relying on Social Security to fund part of their needs, not even all of them. But for you, your needs are covered, and then mostly your wants. As an advisor, it's always beneficial when I'm able to give clients good news that they're going to be able to retire and they're going to be able to do it comfortably. And this is where we start looking at those needs, wants, and wishes. Over 21 years of working with clients, the best conversations I have are with federal employees when we're looking at retirement income because your pensions are so strong. I love having these conversations and showing people how they're going to be able to maximize this and how they're going to be able to achieve, and they're not going to be worried about putting food on the table. The first area I want to tackle when we're looking at your pension are all of those employees that want to retire early. This is a big segment of people that I talk to. At least 10% of the federal employees I talk to have a desire to retire early. And this could be for a wide variety of reasons. It could be you're just tired of the position that you're at. You've been talking to contractors and they're offering you a sweet spot. or you're just kind of burnt out and you just want to be done. But when you're looking at retirement early, you have to be able to look at the downsides. Remember that 4% rule we just talked about a few minutes ago? Well, that's one of the big things that you have to be looking at when you're looking at a new job. If you get a new job, and the pay might be a little bit higher, but what it might not do is provide income for the rest of your life. If you were going to be able to get maybe $1,000 more per month over the couple of years that you're going to work in the last couple of years of your career, will you be able to save that $300,000 on the outside? And remember, this isn't saving it into your 401k. This is outside of the 401k because you're already doing that in the TSP. And many times it won't. And you might say, well, geez, Ed, $1,000 a month for the rest of my life? There's no chance that that's really going to happen. I often see this. We're sometimes $600 to $800, even close to $1,000 for working another couple years and getting to that age 62. We'll talk about that in a little bit more, but this is a real situation. So you have to know your numbers. And more importantly, you have to know your numbers before it becomes a situation that you're ready to retire and you haven't planned for that kind of loss in income. Whether you're looking at retiring early or going the distance of retiring later on, age is one of the biggest factors you have to consider. While a lot of people look at the years of service, to me it's age and meeting that hurdle that is really critical for maximizing your pension. When you're looking at full eligibility, you want to be looking at the age of 62, which requires 5 years of service. Now, if you only went to 60, you would have 20 years of service required. And then there is also the minimum retirement that you could be able to do, but that requires 30 years for both the CSRS and the FERS. But it does get a little bit different here because in the CSRS, you can be able to retire at 55 with a minimum retirement age. But with FERS, it's a difference between 55 to 57. So they have a little bit spread, and it really depends on the specific age or the year that you were born of what that age is going to be. So you need to check those tables out to see what that benefit is. But as you can see, getting to the different age points is very critical for full eligibility. Now, there is a minimum retirement age of 10 years of service, but there are significant penalties that you might have to pay or not be able to get because you're going to be retiring a little bit earlier and you don't have those 30 years of service on the minimum retirement age. This is very big because I see this a lot. This is a very common problem that people are trying to get to a minimum retirement age, but they don't have that 30 years of service in. So they might have to give some of their benefits for a little bit of period of time or take a bigger penalty. Again, age is a very critical factor here. There's also some other provisions and other special circumstances that may apply. There may be mandatory retirement ages, and there's also one that a lot of you know of, but I don't think you really see the impact. I talked about age 62 being that full eligibility number. If you hit age 62 with a 20 years of service, you will get a 10% bonus on your pension. Well, 10%, that doesn't seem like a lot. I mean, when you go to get a sale, 10% off, it really wouldn't make you make a purchase one way or another. But when you're looking at the pension for the rest of your life, that is a big number. And this is where that comes into that factor I was talking about earlier of that $1,000 a month, maybe having to cost you $300,000 to be able to get another job. Let's say your pension is $5,000 a month. A 10% bonus on that is $500 a month for the rest of your life. So just in this one example, that's halfway to that 1,000. And then we also have to add in the years of service, and maybe your high threes are getting a little bit better on those last couple of years as well. So you want to be able to look at age 62 as a critical point to achieve to be able to maximize the pension and get that 10% bonus. Now, some people are just trying to get to their minimum retirement age because they want to get the benefits at that level. But both of them are age requirements, not years of service. So it is a very big distinction and something that you have to be considering when you're starting to plan for retirement, especially when you're younger. Let's take age 62 as a critical age you want to get to, just as I was talking about that in last example. There's a couple ways you can be able to do this. One of them, you can stay in your current job. Hopefully you're happy and you can be able to do this. But sometimes you're just in a position where you need to get out of that area. You just can't either be there locality-wise or the job itself is just making you unhappy, and that is never a good situation. So you have to look at alternatives. So locality is one of the things. You could change your geographic area and move to someplace else if you can stay in that job and do it from someplace else. Now, you might lose some of your locality pay, and that could be a problem, which means that your high 3 might not be your last 3 years, especially if you're in a high locality pay area. Another area that you could do is look at shifting jobs to a different agency or a different job inside the same agency. So maybe shifting the job will give you the enjoyment that you want to get to those last couple years to get to that specific age of 62. Another option, which a lot of people don't even think about, is doing part-time work. If you do part-time work, you are obviously not going to have your high 3 as your last 3 years, but that's okay. You're trying to get to the age, not have the most income in your last 3 years. You've already achieved a good income. And will the last 3 years really prove to be that much of a boost? No. The 62 and that 10% bonus is the boost that you want to have. So when you look for part-time jobs, it might be reducing the hours that you have in your current job, it might be another job in your agency, or it might be finding a job in a different agency altogether. But there are options here. And again, the critical thing is age and not walking away from significant amount of money that could hurt you for the rest of your life. Let's do a quick overview of your CSRS and FERS just to have a reference point so some people can see the differences between these programs. Now, again, I'm not going to get really detailed on this because there's just so many specific information about you that I really want you to have a class or learn what is best for you. And the best way to do that is to get some professional help or start reading that OPM manual or go on the OPM website to really see what specifically affects you. Let's look at the Civil Service Retirement System, or CSRS. Now, the last employee was hired at the end of the year in 1983 to be part of the CSRS system. That was almost 40 years ago, but we are still helping some of them retire. So they are still around. They've just been working there for quite a bit of time, and they're very happy to be part of the government. And so we do help them out occasionally. Now, a CSRS employee, they're contributing 7% of their pay to their pension. But they aren't contributing to Social Security, which means they're also not going to get any Social Security benefits, at least not from the federal employee side. The other factor that you have to look at with CSRS is that there is no matching on their TSP. When you're looking at the FERS, one of the things you have to look at is you're only putting in 0.8% of your pay, which is a very big difference from the 7% that people put into the CSRS system. But wait, they are contributing to Social Security, which is another 6.2%. So when you add the two up together, you're at 7%. You just have Social Security benefits instead of the pure pension benefits that a CSRS employee has. Another big factor is that there is matching, a 5% match on the TSP for all FERS employees, which is a big benefit that the CSRS employees don't get. There was one big change for FERS employees. If you were hired on or after January 1st of 2013, you're considered a FERS Revised Annuity Employee, or FERS RAE. And if you're one of these employees, you are now paying 3.1% of your pay versus 0.8% into your pension. So that is an increase of 2.3%. While this is a big increase, this is a big benefit to make sure that the pension is solvent for many years to come. These are some of the basic features of your CSRS and FERS pension, but there's still so much more. We haven't talked about the CSRS offsets, the FERS transfers, or the special provision employees. There's just a lot of complexity with your pensions. And I really don't want to get bogged down in the rules. I want this to be more about the financial planning aspects of your pensions. So please, I understand that I'm not going over all of the details. You can find them in black and white. I want to be looking at how they affect you and your family for the future. One of those big areas is protecting your spouse. I just talked about how incredible the pensions are. But what happens if you die and your spouse is left there without that income source? Are they going to be okay? I don't know that answer, but you should know that answer. I did a whole video on SBP strategies. Take a look at it. There's a link in the top, but we talk about your survivor benefit plan, your FEGLI, and private life insurance, and different options that you can use to make sure that you're protecting your pension for your spouse or other people that may qualify for a survivor benefit plan for you. Everybody loves a bonus. And in one specific situation, you could get a really good bonus by having your pensions. And that's not the income. It's a program called the VCP, or Voluntary Contribution Plan. But unfortunately, many people either don't take advantage of it or qualify. Let's look at the reasons why they don't qualify. The VCP is only available for CSRS employees. So if you're a FERS employee, sorry, you don't get it. But the people that are a CSRS employee, a lot of them don't take it either. And part of that is for a couple of different reasons. One, they haven't saved the money that they can put into the VCP, or they wait too long. The VCP has to be set up before you retire. There is no chance that you can get it once you retire. So please take a look at the VCP. So what is it? The VCP is a program where you can put up to 10% of your career earnings as a federal employee into a specific account. And with this account, you have two choices. You can create another federal pension for your lifetime based off of this value, or what I like to use is the super Roth component of it. So instead of using the annuity, you actually have tax-free growth for your rest of your life with a huge bucket of money. Now, you also can split it up if you want to do a portion of one or a portion of the other. You do have some flexibility. But the VCP allows you to be able to have more guaranteed income, which I think you probably have enough between your pensions and your Social Security, at least most federal employees do, or a vehicle where you have tax-free growth. Now, it can't be money from your TSP. It has to be money outside of the retirement systems. So this is why a lot of people don't have enough money to be able to put in it, because they've put too much money into their TSP and haven't saved outside of that. But if you have, you're most likely going to be paying taxes on that money. So being able to put it into this program and not have to pay taxes on the growth is incredible benefit to you. Please take a look at this. See if you qualify if you're a CSRS employee. The second bonus program that I want to highlight is a Special Retirement Supplement, or the SRS. Now, a lot of people don't look at this as a bonus. They just think, oh, it's just part of their pension. But for most people, if they were to retire early, they get no supplement. And what the supplement does is it allows you to get income before Social Security kicks in at age 62. So what you're doing is, if your pension is a certain level on a FERS employee, you're going to be missing some of that Social Security income because you're not of Social Security age yet. But the Special Retirement Supplement kicks in when you retire, and you're able to get a full amount, or pretty close to the amount of what you would be getting between your pension and Social Security just a couple years earlier. Now, there are some downsides. One of them is that while you're in the Special Retirement Supplement, you're not going to get inflation protection or COLA increases. Another thing that you have to look at is that with sometimes in some types of retirements, like minimum retirement age with a 10, you're not going to be qualifying for the SRS. So you have to be able to look at the pros and cons of those different areas. But the most dangerous part of the Special Retirement Supplement, and where people may actually lose this, is if they make too much money. Now this year it's just under $19,000 of income. You have to make sure that you do not make more than that, or you will lose the SRS for the following year. Now, there's only a few years that you're going to get this anyway, but that could be a lot of money. We just had a situation where a client got offered a really nice job to work part-time, but their part-time job would be just a little bit more than what the Special Retirement Supplement was going to offer them. So they would essentially be working for free for that first, let's say, $20,000 of income that they had coming in from the SRS, and they would only be making that extra money on top of that. So they're working a lot harder and getting paid a lot less. This is not a good deal. The calculations can be complex, and you want to look at them in a different way. We help clients understand the true value of what they would earn in a week and per hour, so they can see if it's a benefit to work outside of the federal government or to be working inside and keep working for those period of times. Again, if you're losing the Special Retirement Supplement to get another job, you have to look at that as other income that you're not going to be achieving, and why this could be good. Even a side hustle could affect the amount that your income is increasing. So if you're making more than, say, $19,000 on a side job in retirement, you could lose your Special Retirement Supplement. And that could be $1 over. You start phasing out that number. This is a very big benefit, but you have to be cautious that you don't lose it. It does stop at age 62 when you're eligible for early Social Security. If you choose to take Social Security later, you cannot continue the special retirement supplement until the point that you take Social Security. You will just be without income for the special retirement supplement or Social Security component for those years. You will still get your pension, but your income will drop in that period of time. So you just have to be cautious if you're taking this, that you're not trying to delay Social Security for many years into the future, because you will have a gap in income. I mentioned earlier that a lot of financial advisors do not like the pensions that federal employees have. And there's two main reasons for that. But the first one is they can't get paid on your pension. And the reason why is most financial advisors are paid on a percentage of the assets that you have. And that could be either as a commission or something called assets under management, or AUM. Now, Vanguard did a study a couple years ago, and they said the average asset under management fee was 1.09, around $1 million. Remember that 4% rule we were talking about before? And we used an example of $5,000 of income? That would be $1.5 million that you would have in an account if you didn't have a pension. But because you have a pension, there's no $1.5 million. So the advisor at that 1.09 is losing more than $16,000 a year of income because there isn't an asset to charge. They don't have a way to charge your pension. And this isn't saying that advisors are bad. It's just saying that your pension is costing them money, and nobody likes to lose money. We also understand that everybody needs to charge for their services to be fair. We think that we've come up with a system which allows us to get education and get you the information that you need on all different factors, and we're not just charging based off the investments. So for us, it's not about how much money you have, and we're not hurt by your pension. We actually like them. The second factor of why financial advisors generally do not like the pension is because they're too complex. So if you look at the combination between I'm not going to get paid on them, and they're complex and I can make a bad decision that could affect you, it makes for a situation where advisors just don't like that. Again, we've just scratched the surface on your pensions today, and they're very complex. Imagine when they have to really get into the details and make sure that you're very much protected, which is what an advisor should be doing with a fiduciary relationship. Now, you want to make sure that whoever you hire or wherever you go to for information understands your pensions and all your benefits very well, because this is going to affect you for the rest of your life. We have been trained to know your benefits, specifically your pension and all of the ins and outs. We also use outside resources to make sure we have the most accurate information, so when you have a special situation or a very unique question, we can get that answer to you very quickly. I just had a situation this week where somebody had been asking their HR department for a while for an answer, and they refused to get him the answer. We got him the answer within 3 days because we had to do a little bit of research. And that's the type of resource that you want to have. And an advisor that knows the business or knows where to find those answers isn't afraid to give you those answers. I mentioned earlier that there's workshops that are available. If this video has caused you to be able to look at what you want to be able to do, please go into the description section, take a look at the workshop, and if it's for you, sign up. If it's not, that's perfectly fine too. If you're still watching, you've probably found this pretty valuable. As always, we create an ebook for the fundamental series of these videos, so if you want to look at it in a different format, you can download our ebook. The link is below in the description section. And if you like this and found it very valuable, please hit that like button so we know to create more content like this. And if you want us to be able to look at a little bit more specifically about a certain topic, please put a comment there. I love comments, good or bad. So please, if there's something you want to hear more about, let me know, and I will do my best to add it to the list of topics we already have planned. Today we've talked about a lot of different things, but one of the big things is that this is a very complex subject, and you need to be able to know what you're doing before you make decisions that could affect the rest of your life or the income for the rest of your life. We've discussed retiring early. We've looked at some of the bonuses that you can possibly get, and we looked at some of the overview of the systems. Again, not too much in the details. We want you to find the best solutions for you and your family, so please get unbiased, conflict-free advice. Thank you for your time today, and we look forward to talking to you in the next video.